On Monday, June 19th, during the Asian session, spot gold traded in a narrow range and was currently trading around $1,957.14 per ounce. Last Friday, the gold price rebound was hindered by better-than-expected U.S. consumer confidence data and hawkish speeches from Federal Reserve officials, which helped the U.S. dollar and U.S. bond yields to bounce back, causing some concerns for gold bulls. Additionally, the U.S. stock market reached a more than one-year high last week, further suppressing the safe haven demand for gold. The first statements for Federal Reserve officials after their meeting last week displayed a hawkish tone. In its last monetary policy report submitted to Congress, the Federal Reserve stated that inflation in key sectors of the U.S. service industry remains high with no sign of abating. The hawkish comments from Federal Reserve officials seem to partially offset the support brought by the weakening jobless claim data on Thursday, keeping the gold price range-bound. The US dollar index made some gains, but its weekly performance is poised to be the worst in 5 months, as traders also assessed a survey by the University of Michigan. The survey showed that the US consumers' one-year inflation expectations dropped to the lowest level in over 2 years in June, with a slight improvement in inflation expectations for the next 5 years. On Friday, June 16th, the euro remained unchanged against the US dollar at $1.0940 after reaching a 5-week high. On Thursday, the euro surged over 1% driven by the European Central Bank's interest rate hike and forward guidance. ECB President stated in a press conference that there is a high possibility of another rate hike in July, and the central bank still has things to do to avoid high inflation. In contrast, the Federal Reserve paused its rate hikes last week after a series of 10 consecutive rate increases, although the Federal Reserve also mentioned that interest rate may still need to rise by 50 basis points by the end of this year. Recent data shows that economic activity in the US is slowing down and inflation is cooling off, posing a challenge to the Federal Reserve's still somewhat hawkish stance. The British pound continued to rise against the US dollar by 0.31%, closing at 1.2825, with a weekly gain not seen in 6 months. Several factors last week boosted the British pound against the US dollar, including data showing faster than expected wage growth in the UK, raising investors' expectation for further interest rate hike by the Bank of England. The Bank of England's main interest rate is currently at 4.5%, and based on derivative market trends, traders expect it to rise to around 5.75% by early next year. The Australian dollar hovered around $0.6880 against the US dollar, reaching its highest level in 4 months. The improved market risk sentiment, along with the unexpected rate hike by the Reserve Bank of Australia in June, injected new vitality into the AUD-USD pair. The hawkish stance of the Reserve Bank of Australia, in contrast to limited upward risks in the US federal fund rate, stimulated a rebound in the Australian dollar. On the other hand, the Bank of Japan kept its ultra-low interest rate unchanged last Friday and predicted a slowdown in inflation later this year, reiterating its dovish stance. The yen weakened against all currency pairs, indirectly supporting the Australian dollar's strength. As widely expected, the Bank of Japan maintained its short-term interest rate target at negative 0.1% and the upper limit for the 10-year bond yield at 0, as set by its yield curve control policy. Bank of Japan governor stated that he expected inflation to ease, but the pace of decline is somewhat slow. This week, the data releases are relatively quiet, with some countries and regions publishing CPI and PMI data. Federal Reserve Chair will testify before Congress, and several central bank officials will deliver speeches. Investors should pay attention to those events.